Obviously, they've been fined by the SEC because there was a material difference between what they've been telling to investors and actually what they've been doing internally within their fund. So they've taken these traders from the external fund that was client-facing and moved them to run internal money. And as part of that, they then replicated their trades using an algorithm to keep the client-facing fund running, theoretically using the same strategy. But obviously there were many issues with this, a lot of it to do with the fact that the replication strategy that they were using was trading the trades that they would put on internally on a day delayed basis. So you've got a fund here putting on a position, and then that's being replicated the next day to the client-facing fund. And thinking about it, actually that's not really mentioned within the SEC findings. That has massive implications from a front-running perspective. If you're getting a trade on one day and then that there's a replicating algorithm that's going to repeat that trade the next day, that is a huge red flag for the fact that could end up you've got a trade on here at price X and you've got the replication trade coming through, which could well be pushing up the price of price X. So you're getting that kick that's coming in from a trade that is on the way. And in fact, if you look at the SEC results, a lot of the issues came about because there was massive underperformance from the client-facing fund. It's raised issues also around documentation. The SEC were really concerned with the fact that there was a material difference between the documentation that would have gone out to clients and what they ended up doing. And certainly, I've set up my own hedge fund relatively recently. We spent a lot of time on documentation. It took about 9 months of toing and froing to get our documentation correct. And the FCA, who we were regulated by in the SEC, are very keen that the documentation that goes out does what it says on the tin. You can't, for instance, just write a prospectus to say, we're going to be trading equities, and then 2 months later you're starting to trade commodities. And certainly a lot of the work that we have done, SKADI's done in the past, has been looking at documentation. One of the other interesting things it raises is around algorithms, and we've done some work looking at auditing algorithms within financial institutions. Obviously, there's the famous case back in 2012 of Knight Capital, who famously blew themselves up within 15 minutes, losing $440 million in an algorithm that hadn't been tested properly before it was released through to the production side of things. And I just think it's really interesting to look at this case from both those perspectives, from the algorithm perspective, and also looking at it from the perspective of what's gone on with regard to replication. Anyway, thanks for listening. Goodbye.